Let's be honest, US tax law can feel like a total maze, right? Especially when you're staring down the CFPR exam. So that's what we're going to do in this explainer. We're going to demystify some of the trickiest topics out there and turn these super complex rules into concepts that actually make sense. Let's dive in.
All right, so here's our game plan. We're breaking this down into 3 parts. First, we'll hit the fundamentals. What even counts as income and assets? Then, we'll get into the specific rules for businesses and property. And we'll wrap up by looking at some key tax situations that you, as an individual taxpayer, are probably going to face. It's going to give us a really solid foundation.
So let's jump right into part 1, the building blocks. Look, if you want to master tax planning, you first have to get a handle on what the IRS even considers income and assets in the first place. This whole section is about getting those core definitions down cold. Okay, let's kick things off with a classic scenario. Picture this. Allison sells antique furniture. It's her side hustle. She's making some money, but she's also got expenses. So the big question the IRS is going to ask is this a real business or is it just a hobby? And trust me, the answer completely changes the tax math. Here is the absolute core rule for hobbies. You have to report every single dollar of income you make. But, and this is the part you really got to hear, you can never claim a loss. Your expenses can wipe out your hobby income, sure, they can take it down to 0, but you can't use them to lower your taxes on, say, your main salary. So let's run the numbers for Allison. She brought in $3,000 in revenue. We can subtract the $2,000 she actually spent on the furniture itself. That leaves her with $1,000 in taxable income. But notice this. What about all her other expenses, like office supplies? Nope, doesn't matter. Because it's a hobby, those costs are gone. They can't be deducted.
Okay, so we've got a handle on income. Let's flip the coin over and look at assets. You know, most things you own for fun or for investment, like your stocks, your car, those are capital assets. But the IRS has this very specific list of things that are exceptions. And honestly, knowing what's not a capital asset is just as important. Here's a super easy way to remember this. Just think of the little phrase, ACID plus IP. It stands for accounts receivable, copyrights, inventory, and depreciable business property, plus intellectual property. If an asset is one of those things, it's not a capital asset. So for example, that delivery truck a business uses, that's depreciable business property, so it falls right into this category. All right, let's jump into part 2. Now that we have the fundamentals down, we can start applying them to the big stuff, like businesses and property. And this is where that strategic tax planning can have a massive impact. If you only remember one single thing about a C-Corp, make it this. It is the only business structure where profits get taxed once at the corporate level, and then they get taxed a second time when they're paid out to shareholders as dividends. This double taxation is its absolute defining feature. To figure out if you have a taxable gain or loss, you've got to know the asset's basis. Let's break down the 3 big ones. For business assets, you use an adjusted basis. That's your original cost minus any depreciation you've taken. If you inherit an asset, you get what's called a step-up basis. The basis becomes the market value on the date of death, which is a huge tax benefit. And if you're given a gift, it's a carryover basis, meaning you actually inherit the giver's original cost. But wait, there's a 4th type that's absolutely crucial for these tax-deferred deals. It's called substitute basis. In a special transaction like a 1031 exchange, you don't get a new basis. Instead, the basis of the property you gave up just slides over and substitutes onto the new property you got. It's how the IRS keeps track of the gain that you haven't paid tax on yet. All right, let's tackle a trickier one. What happens when you sell a business asset that you've been depreciating, let's say a piece of machinery, for more than it's worth on your books? Well, the IRS has a very specific and kind of clever way of treating that gain. The secret here is that the IRS makes you split the gain into 2 different buckets. First, any part of the gain that came from the depreciation you already took gets recaptured and taxed at your regular ordinary income rates. That's Section 12045. But any gain you made above what you originally paid for the thing, that gets treated as a Section 123 gain, and it gets those much nicer, lower long-term capital gains tax rates. This is one of the most important distinctions in all of tax planning: realized versus recognized gain. Your realized gain is your total profit on paper. It's the whole shebang. But your recognized gain, that's the part you actually have to report and pay taxes on this year. Think about a 1031 exchange again. You might realize $1 million gain, but in the current year, you recognize 0.
Now, to successfully pull off one of these tax-deferring exchanges, you have got to follow the rules to a T. The properties have to be like-kind, and both have to be used for business or investment. And hey, let's bust a common myth right here. You can actually exchange property with a relative. There are just some specific holding period rules you've got to be careful about.
And now for our final section. Let's bring all these concepts home and connect them to the real-world decisions that investors and homeowners have to make every day. This is where the rubber meets the road. So, you have a rental property and it lost money. Can you deduct it? Well, yes and no. You can potentially deduct up to $25,000 in losses against your other income, but it all hinges on your adjusted gross income, your AGI. You only get the full deduction if your AGI is under $100,000. After that, it starts to phase out, and once your AGI hits $150,000, poof, it's completely gone.
Here's a rule that trips a lot of people up. When you take money out of a non-qualified annuity, it follows a LIFO rule. Last in, first out. Why? Because the IRS wants to get its tax money first, of course. This means all the earnings that have been growing tax-deferred have to come out first and get taxed as ordinary income before you can touch your original investment, your principal, tax-free. Okay, let's actually calculate an AGI together to see how all the pieces fit. We start with the salary and dividends, of course. Then we subtract capital losses. But remember, you can only deduct a max of $3,000 a year against your other income. And here's the key item, that municipal bond interest, totally tax exempt, so we don't include it at all. Add it all up, and the final AGI is $102,000.
This is a big one for homeowners, and it's so easy to get wrong. You can only deduct mortgage interest on the portion of the debt that was used to buy, build, or substantially improve your home. So if you do a cash-out refinance and use that money to pay off your car loan, the interest on that part of the loan is not deductible. If you're self-employed or have a lot of investment income, the safe harbor rule is your absolute best friend. To make sure you don't get hit with underpayment penalties, you just have to pay the lesser of two numbers, either 90% of what you'll owe this year or 100% of what you owed last year. It's a simple way to protect yourself. When you're planning for education, the little details mean everything. Using Series EE bonds to pay for college can be tax-free, which is great, but there's a catch. The bonds have to be in the parent's name or the student's name. If a grandparent owns them, like in this scenario, the tax break is off the table. In that case, the American Opportunity Tax Credit, which can be worth up to $2,500, is a much, much better choice. Look, if you remember nothing else from our time together, burn this one phrase into your brain. You have to realize a gain before you can recognize it. It perfectly captures the order of operations. First, you calculate the total profit on paper. That's realizing it. Then, you apply all the tax rules to figure out what part is actually taxable this year. And that's recognizing it. We have covered a ton of ground, from hobby income all the way to complex property exchanges. But now, the real question is for you. Take a second and think about your own financial plan. Which one of these strategies we talked about? Maybe the step up in basis, or maybe that rental loss rule. Which one could have the biggest impact for you? Because understanding these rules is the first step to making them work in your favor. Thanks for joining me for this explainer.